Well, welcome to Grant's Interest Rate Observer of the Air. I'm Jim Grant, and with me today is, we got the great Evan Lorenz, Deputy Editor of Grant's. We have Phil Grant, who runs as a kind of a separate profit center around here, something called Almost Daily Grants, which is the must-read daily delectation about the financial markets. And to my immediate left is Eric Whitehead, who is on the dials and controls. And with us especially today, a special guest is Mark Spiegel, who is the managing member of Stanphyl Capital. So, Mark, welcome to you.
Thank you. It's great to be here. And as I said earlier, Jim, I'm a huge fan of yours. I've been reading you since the Barron's days, even before I worked on Wall Street.
Oh, my goodness. Well, thank you, Mark. Hey, we have, this is capitalism. We got a couple of sponsors. We have ZipRecruiter and we have eFinancial Careers, which is kind of like Macy's and Gimbels, but we'll sing the praises of both presently. But first and foremost, Mark, welcome to the Grants podcast, and tell us a little bit about your MO. Phil is a big fan of yours on Twitter, and he quotes you as saying, quote, "I buy deep value and short bubbles, and I don't do it quietly." Now, that is a great line, but is it is it like a moneymaker these days, or what? I mean, the shorting of the bubble stuff.
So the fund is really almost like two funds in one, and it's one of the reasons we're so small, but it's just the way I want to do things. On the long side, we are deep value, micro cap, and nano cap companies with high gross margins, great balance sheets that I can buy at a small fraction of revenue typically. And by the way, I found very few new ones to buy recently. But at any rate, that's how the fund has made money on the long side. I opened the fund in June 2011. And on the short side, it's been macro and bubble stocks, many of the usual suspects. And that's lost us money. So overall, to answer your question in this long-winded manner, since inception in 2011, we're up a tiny bit over 11% compounded annually, despite having huge short positions.
Wow.
To put that in perspective, the Russell 2000, which is our microcap benchmark, we've exactly matched that. And the S&P compounded with dividends is slightly over 13% annually in that time. So we've come pretty close to the S&P with a lot of big shorts, which have given me the confidence to put on those long positions.
Mark, your Twitter fans know a little bit about the names that are in your portfolio. And there's one that I recognize this name from other contexts. I think it's an aspirational car maker called Tesla. Now, could you tell us a little bit about, in the remaining 2 hours, can you give us an overview of your love affair with Tesla, of your love affair in reverse with Tesla?
So I can give you three sort of bullet points as to why I'm short Tesla, and then we can go as deeply into the weeds as you like or don't like. Number one, Tesla has no moat of any kind. It has absolutely nothing meaningfully or sustainably proprietary. Number two, it loses a huge and increasing amount of money despite relatively light competition, but will soon be confronted with massive competition in every aspect of its business. And number three, Elon Musk is an extremely untrustworthy stock promoter who, as far as I know, has actually never run a consistently profitable company. I mean, even SpaceX, they used to say on the website, was profitable, and the Wall Street Journal had an expose on it last year that was losing money, and they had to change the website. So those are the three bullet points right there.
So this particular annoying equity was up 46% last year in the face of earnings miss, in the face of all manner of disappointments, in the face of a yawning gap between promise and delivery, what is going on, and whom do we see to fix this?
That's a great question.
Yeah.
It's really the cult of Elon Musk, and that cult is, I think, gradually being chipped away. The cult defined as his credibility. I mean, look, as you may know or probably do know, when you're short something and you're short it in size, you do your homework and you keep doing your homework and you keep saying to yourself, what am I missing? What am I missing? And I've spoken with or engaged with or seen speak pretty much every long holder of note of this stock. And universally, they have no facts to work with. They avoid facts. They avoid all the stuff I'm talking about. And they just say, well, Elon is great. He's going to do it. So it's a religion for those guys. But here's the thing. This is a religion, well, actually like many religions, but this is a religion that takes $5 billion a year in fresh capital injections, just to keep the lights on. So it's one thing for a guy to say, oh, Elon is God and I'm going to own his stock. It's another thing to keep dipping into your pocket for the guy. And that's another reason why I'm comfortable being short this. I mean, if everything I knew, and yet the company was sort of breaking even, I'd be like, screw it. It's not worth sticking around for this. But the fact that I know it's burning so much cash, I know it's got to come to an end at some point, and I'm ready to stick it out as I have.
How long have you been sticking?
Well, so I put on a tiny position of this thing when it was in the high 90s.
And that became a big position.
I think around 4 years ago. But I mean tiny.
Yeah.
I run a concentrated fund, and that was less than 1% of AUM. It's the smallest position I've ever put on in anything. But I got much, much bigger a few years ago when it was north of 250. And I've been very big since then. It actually dove down into the sort of the mid 100s in the fall of 16, and then just came roaring back all through last year. So my basis on this thing is probably blended in, probably low 200s, something like that. I mean, I've had to cover some on the way up, and then I've put more on as the fund got a little bigger, and I got more confident. So it's been a trip. But here's the thing: time is not on Tesla's side, because the competition gets closer and closer and closer, and the company itself is showing negative scale, meaning it's losing more money the more cars it produces. So, those lines are about to cross. It's not as if things are getting any better for Tesla. They're only getting worse.
Hey, I'm intrigued by the idea of nano-cap stocks as opposed to mere micro. If you would please define nano-cap and tell us, just for example, one such company.
Okay, well, I guess there's no strict definition of nano-cap, although typically it's companies with market cap of under $100 million. Here's what I look for in those companies. My number one metric is enterprise value to revenue, okay? And then I look at everything after that. And I look to buy companies at less than 1 times annual gross profit. And ideally, because these companies are never making much net profit, but ideally they're breaking even or maybe only losing a little bit of money and have, good clean balance sheets that can sustain them for a long time. The reason for this is at some point, some bigger company is going to come along and buy them just to pick up the revenue if they can buy revenue cheaply enough. Even a good gain for me on these companies would be a sale at 1 times revenue, which is dirt cheap in this market. And, then they'll be acquired and a bunch of people in the C-suite and the auditors and all that stuff will be eliminated. And all of a sudden, it goes from break even to making some money and it's a good acquisition for somebody. So normally in a normal market, I can find, 4 or 5 of these things, 6 of them a year to add to the portfolio. I've only added one new name in over a year. I mean, we own a couple of legacy names. One of them recently got bought. I'm hesitant to talk specific names because these companies are kind of illiquid, but, I can tell you one that we just added. The ticker is AVNW. And what they do is they make microwave towers for telecom backhaul. The company's called Aviat Network. And, we just bought it really cheaply. I mean, let me put it this way. It's selling at around, on an EV basis, probably 15% of revenue, something like that. It has 30% gross margins, and it's actually generating a little bit of cash. So, it's the kind of thing somebody will buy it. They have hundreds of millions of dollars of NOLs. They have 30 million of net cash. And, so I'll sit on these companies. Sometimes they pick up in a few months, and sometimes it takes a few years. There's one that just got sold. I had owned for 4 years. Ticker was MGC Diagnostics. But it turned out to be a great IRR because I had added to it on the way down and it paid a couple of special dividends. So the disadvantage of this strategy is that it doesn't scale. So my fund is very small and, I'm going to cap, and one of the reasons it's very small is I'm capping it at $50 million. And the reason I'm capping it at $50 million is that, if I want to own 10 or 12 of these companies and own 10% of each company, and the company has an average market cap of, let's say, $40 million, there it is right there. So my ideal company is a company that if I showed this to sort of a brilliant, famous value investor, I don't know, a David Einhorn, of whom I'm a big fan, or somebody like that, I'd be like, David, you got to look at this. He'd be like, Mark, to me, that's a no-brainer, except I can't touch it because I'm running, $8 billion or whatever. Those are the companies I look for. As I said, unfortunately, that strategy doesn't scale. But you know what? I have low expenses here. I outsource administration. I outsource audit. I outsource legal. It's a comfortable living and it's a low pressure living because it is such an inefficient market down there. My worst nightmare would be someone handed me $5 billion and I had to figure out how to put it to work.
You know what? That's my nightmare too. God, so. Evan, what were you going to ask, Mark?
Mark, you said it's very difficult to find kind of good small companies right now. And one thing that we've noticed in this recovery is there's just been very little new business formation, especially new public companies coming to the market. When you say that you can't find new companies, is it that you can't find new companies at the right value, or just there's not as many of these little kind of, entrepreneurs coming to the market and innovating and creating new products that people want to buy from them?
And the answer to that, I think, is first of all, when companies come to the market, when they IPO, they're typically premium priced. I mean, pretty rare you see a stock IPO at a deep value kind of valuation. So
that happens in month 3.
What's that?
That happens in month 3. Yeah.
right. Yeah, I actually had one of those.
I think Blue Apron took 4 months.
Yeah, we all have. Don't worry about it, Mark. It just happens to the best of us.
Yeah. No. I mean the other way.
Oh.
I mean, I bought it after it collapsed. Yeah. No, I never do IPOs. It's just like I just don't do them. So, but it's pretty rare. And so I basically have fallen angels that have been around a long time. But that said, the ones that were good, have increasingly gone private. And there haven't been a lot of new ones going public in the last few years, in which they would have time to fall. And then by now, maybe I'd be buying a 2012 IPO today because it fell. But there just aren't a lot of them. I guess some of that was, tighter SEC rules. And there was just, so much money in private equity and venture capital that a lot of companies never had a chance to get public.
Well, Mark, I predict there's going to be a whole lot to do in some of the fallen crypto angels. You can get into those a little later. And now a word from one of our two sponsors today. It is a bull market. eFinancial Careers. It's the world's leading financial services career website. Discover career-changing opportunities across the industry from leading brands to niche firms. Why not take the hard work out of job hunting? Register today to let recruiters find you. You can create a profile, let recruiters easily match you to their open roles, save jobs, create alerts to stay informed of the latest opportunities, upload your resume and cover letter to quickly apply to jobs. So check out the site, efinancialcareers.com. That's efinancialcareers.com. I wanted to ask you about one of your longs, which is the PowerShares DB Agriculture ETF, which sounds like a La Nina play to me. But tell us why you're interested in agricultural commodities.
So, I never had any interest in agricultural commodities before. And in December, just last month, I started looking around and said to myself, okay, what is the cheapest thing out there that's not a buggy whip and is not cyclical from the demand side? And I zeroed in on agricultural commodities. And this ETF, the ticker is DBA, which, I think it's the Deutsche Bank Agricultural something it stands for because it's based on one of their indices. I just remembered it doing business as. That aggregates, I think, 10 or 11 of these ag commodities. It's basically, collectively, this index is back to where it traded in around 2003. Well, we've had a decent amount of inflation since then, and every other asset class in the world has soared. And I just kind of thought, maybe this is something that has bottomed out, especially because the biggest issue has been oversupply from easy credit going to farmers. And yet those guys are full up on credit and, in fact, are having trouble, paying the debt and are starting to default, which is going to contract supply. So that's what it is. It's basically, I took a shot at the cheapest asset I could find, and I'm hoping that it bottomed out. And look, if it hadn't bottomed out and it goes a little lower, that's okay too. Maybe I'll add to it because the population is growing, and that means intrinsic demand for food is growing.
And a most grateful word to our sponsor, ZipRecruiter. A fresh new year has begun, and if you're setting new goals for your business, it's hard to reach them without the right people on your team. And ZipRecruiter has transformed how you go about finding those people. So ZipRecruiter posts your job to over 100 of the web's leading job boards with just one click. And then ZipRecruiter actively recruits for the most qualified candidates and invites them to apply. They even review every application to identify the top candidates, so you never miss a great match. So no wonder 80% of employers who post on ZipRecruiter get a quality candidate through the site in just one day. ZipRecruiter, the smartest way to hire. So to find out today why ZipRecruiter has been used by businesses of all sizes and industries to find the most qualified job candidates with immediate results. And right now, our listeners, can post jobs on ZipRecruiter for free. That's right, free. Just go to ZipRecruiter.com/grant. That's ZipRecruiter.com/grant. And one more time, to try it for free, go to ZipRecruiter.com/grant. Thank you, ZipRecruiter.
Mark, what is the trend with farmer delinquencies? Are farmers going bankrupt faster or paying loans slower?
Well, I think it's both. I mean, there was a big article actually, and I don't have the specific statistics, but there was like a full-page article in the Journal, I think one day last week, about how hard it's been for farmers who had to load up on debt, not only because they aggressively wanted to expand, but with prices so low, they've had to load up on debt just to keep the lights on. And, unfortunately for those guys, because we need farmers, and these are hardworking guys who have no interest in the nonsense that goes on Wall Street. These guys are starting to default, and I think we're going to see a reduction in supply because of it.
Okay, I'm starting to get the picture, Mark. This sounds like kind of an eccentric strategy, but here it is. Tell me if I'm wrong about this. All right, so the idea is to buy things that are cheap and to sell things that are rich. Is that overanalyzing it?
I actually, it's good you picked that up. It's good you picked up on that. I thought I invented
Nothing
it.
gets past us here.
No.
Sell high.
Yeah. Well, I don't know. It doesn't sound like a moneymaker, but who knows? This is a new year, and anything is possible. Mark, thank you for being with us. Mark Spiegel is the managing member of Stanphyl Capital, which I gather, Mark, that the name Stanphyl is a hyphenate of your parents' names. Is that?
It's exactly what it is.
Yeah.
Yes. Stanley and Phyllis, I put them together, and I owe a lot to both of them. So I figured, what the heck? Here's my tribute.
Well, Mark Spiegel, I think that is a lovely thing, and I think that you have on your side, if not an investment strategy, because this buy low, sell high thing may or may not work out, but I think you certainly have karma on your side, and you have our gratitude for being with us today. So thank you, Mark Spiegel.
Thank you so much for having me, and I look forward to continuing to read your work, Jim.
And thank you, Mark Spiegel. Ladies and gentlemen, thank you for listening. Until the next time, this is Jim Grant for Grant's Interest Rate Observer of the Air.